The Bank of Canada just released their most recent financial system review, and they are forecasting more financial pain is in the works for Canadians. And this is no surprise, as higher interest rates are eroding the budgets of many homeowners, with some mortgages renewing with up to 40% higher payments. And that, combined with higher rents, has many Canadians turning to credit cards in order to subsidize their monthly payments. And in this video, I'm going to translate the most recent financial system review from economist to layperson so that you can understand exactly what it means and give you some tips on what you can do to prepare for the future, especially if you've got one of those variable rate mortgages with fixed payments, or you've got a fixed rate mortgage that's coming up for renewal in the next 1 to 2 years. So make sure you watch till the end, because that is where the most important information is going to be. But before we get into it, my name is Nolan Mathias, and if you want to thrive financially, this is the place for you. So do me a favor, hit the subscribe button so more people like you can see this video and so that you get the most recent updates. And by the way, there's another video coming later today that's going to talk about fixed rate mortgages, because those are also going to be on the rise very shortly. So turn on that notification bell. Okay, so let's jump into the financial system review. I'm going to show you the headlines, and then I'm going to show you the actual financial system review. These are the headlines. First and foremost, from Bloomberg, this was the first one this morning. Stressed homeowners in Canada are turning to their credit cards, with credit card utilization up 17%. And I'll get to that in a second when we get into the actual financial system review. Then we've got another one from Bloomberg. Bank of Canada sees financial stress rising among homebuyers. I don't think we need Bloomberg or the Bank of Canada to tell us that this is an issue. Pretty much anyone who is a homeowner at this point in time is feeling the stress, either from having their payments go up or with the prospects of payments going up in the next couple of years. And there's a lot of people hoping that interest rates are going to come down. They may not necessarily do that. And if they don't, pretty much everybody is in the same boat. It's just a matter of whether you felt it early or whether or not you're going to feel it later in the cycle. And then from the Globe and Mail, we've got the Bank of Canada says mortgage payments could spike as much as 40%. So obviously this is a big day from a news perspective with respect to mortgages and with respect to household finances. But let's take a look at what's actually going on here and take a look at what the financial system review actually talks about, and then see if we can figure out what it means for Canadians, what it means for you, and how we can prepare for the inevitable rising interest rates that you're going to feel if you haven't felt them already. And by the way, if you are a person who has a variable rate mortgage with a fixed payment, or you have a 5-year fixed mortgage, you need to be paying attention to all of this stuff, because planning for this right now instead of waiting for the inevitable to happen, which is a big payment shock, is going to be vitally important. And I've been saying this for the last 2 or 3 years. This is why we promoted variable mortgages with adjustable payments, is so that people would feel the changes in interest rates gradually as they happened, rather than for it to all kind of backload and end up happening all in one day when those mortgages come up for renewal. So let's take a look here. Households. This is obviously from a very large document, and households is just one piece of the financial system review, but it is a big piece right now, and it has been for the last several years. Some of the highlights from this are the share of new mortgages with an amortization period longer than 25 years has increased from 41% to 46% in 2022. In 2009, this number was 34%, and almost all of those mortgages that had an amortization longer than 25 years were conventional 30-year mortgages that had greater than a 20% down payment. Now what's happening is this number is increasing because many variable rate mortgages with fixed payments are amortizing into longer amortizations because the payments aren't changing, and this is why this number is increasing so much. Now, there's also a certain portion of this which is conventional buyers who bought in those big markets like Toronto and Vancouver, who bought with 30-year amortizations because they had the option to and because it reduced payments. But we've basically got two forces that are increasing the number of 25-year plus amortizations, and that is the negative amortization as well as the values of properties being over $1 million in several major markets. Now, they also go on to talk about the debt service ratios. And the key piece of data here is that the share of new mortgages with a debt service ratio of more than 25% increased from 12% to 29%, basically in the last couple of years. Now, that is a big adjustment, because what that means is almost 30% of mortgages now have debt service ratios that are greater than 25% of a person's income. Now, yes, granted, when you get a mortgage, you can go up to 39% in some cases of your income going towards your mortgage payments, as well as your other living costs. But as a general rule, people typically don't put that much money into their mortgages, but that has increased substantially, especially after 2019. And I like to always see clients be at around 25% of their income going towards their mortgage and housing expenses. Obviously, people push this a little bit, especially if they're young families and they're looking to get into a home that will be their lifelong home. But this is a big increase in numbers because from a financial stability standpoint for the overall country, what this means is that those debt service ratios are pushing up quite substantially and substantially higher than they've been in quite a long time. Now, there's some really interesting charts here in this report. Housing prices across the country, I find this chart really interesting coming from a real estate perspective. As you can see in Canada, as a general rule, housing prices have dropped quite substantially. But there are markets where this isn't necessarily happening. If you look at Calgary, for example, Calgary's home values compared to February of 2022 are actually higher than they were in that month. Sorry, not in that month, in that year. And then if you look at Quebec, same sort of thing. Now, there's obviously markets like the Greater Toronto Area and cities around the Greater Toronto Area that have come down substantially, as well as that Greater Vancouver area, although not to the same sort of extent. And what this tells us is that there's a tale of multiple markets, and it's really two markets. It's the big Vancouver, Toronto markets, and then the rest of Canada. And the rest of Canada is very much operating differently than what those other two markets are. And those two markets, Vancouver and Toronto, probably have the most financial risk when it comes to the broader economy and dealing with the higher interest rates. Because, like I said in a previous video, which a lot of commenters disagreed with, an average household income, and let me clarify, it's household income, which is usually multiple incomes, still buys you an average home in a lot of Canada, just not in Vancouver and Toronto. Now, there's been a lot of media news with respect to mortgage arrears, and a lot of people suggesting that almost all the mortgages in Canada are going to be in arrears. And I love this chart because what this chart shows is unemployment rate relative to the number of mortgages that are in arrears. And as you can see, the arrears rate is very low. That's the yellow line here. It's less than 0.2%. This is partially due to the fact that different lenders and government institutions have created scenarios where borrowers who probably should be going into default aren't, which is maybe a longer term problem. But it goes to show that as of right now, especially with the job scenario the way it is, people are still making their payments on their mortgages. Now, the thing that concerns me is what happens when interest rates continue to go up, what happens when demand goes down, and what happens to unemployment. Because if you take a look at other times in history where we started to see mortgage arrears increase, it was typically in times where unemployment was starting to increase substantially as well. And if we find ourselves in a situation where unemployment starts to increase, that could be catastrophic for our mortgage market. Because as of right now, people are still working, they're still able to maintain their mortgage payments. But if people stop being able to work, then they won't have the money to make the payments that they need to make, and that will lead to a greater number of arrears. And I suspect sometime in the next 5 years, we're probably going to see both of these numbers, unemployment and mortgage arrears, go up pretty substantially. Now, even though mortgage arrears aren't increasing, there are some areas of the economy where arrears are increasing. First and foremost is on installment loans. These are the type of loans, they're not necessarily car loans because car loans are a type of installment loan. However, they aren't included in the installment loan category. They're broken out on their own, which leads me to believe that most of the installment loans that are in arrears are actually loans that were debt consolidation loans. Now, the arrears are obviously going up substantially on those, but we also see credit card arrears going up. We see automobile loan arrears going up. And we see unsecured line of credit arrears going up. So the one place where people are continuing to make their payments is on their mortgages, but with higher amounts of consumer debt, higher amounts of credit card debt, it's starting to appear that some Canadians are starting to miss their unsecured debt payments. And eventually that will creep into the other categories, including mortgages. Now, with respect to the number of mortgages that have had their payments increase, as of right now, about 1/3 of mortgages in Canada have seen their mortgage payments increase. And these are either one of two types of mortgages. Mortgages that have come up for renewal or adjustable rate mortgages. So variable rate mortgages with adjustable payments, which are the type that we've typically recommended. And as you can see at the end of 2022, we've seen a pretty reasonable amount of mortgages come up for renewal. By May of 2023, this is getting greater. And then by the end of 2023, by the end of 2024, by the end of 2025, and by the end of 2026, we're going to see the amount of mortgages that have had their payments change go up substantially. And obviously, the two biggest years, according to this chart, where we're going to see the biggest changes are in 2025 and 2026. So all of those people who got their mortgages at 1.2% or 1.3% in 2021 are going to feel a pretty substantial amount of pain in 2025 and 2026. And there's good news and bad news here. The good news is you got a really low rate. The bad news is it isn't going to last forever. And just like everyone who's feeling the pain right now, you eventually too are going to feel the pain, but you have one advantage if you take advantage of it. And that is the fact that you have a time horizon to start to prepare for those higher payments. So let's take a second and talk about what you should be doing if you've got one of those types of mortgages. Because if you've got an adjustable rate mortgage, you're already feeling the pain gradually. There might be an opportunity here to lock in at some point, and you may want to take a look at those options right now, especially as fixed rates start to go up, because they are starting to go up as clarity is being created around the US debt ceiling. But if you've got one of those variable rate mortgages with fixed payments, or you've got a fixed payment mortgage, there's some things that you need to be doing right away. First and foremost, what I would be doing is I would be taking a look at what current interest rates are right now, and then I would be running the numbers. You can do that by using the mortgage calculator that's linked in the description below. And basically what I would be doing is I would figure out what your payment would be if it changed today. So in other words, take your mortgage amount, your existing amortization, plug in the numbers using existing interest rates. Those are also in that app. Then figure out what your payment would be if it changed. Then subtract your existing payment, and that's going to be your payment difference. And this is the number that you need to start thinking about, because this is the number that you should be doing your best in order to start saving on a regular basis. In other words, what I want you to do is I want you to start taking that amount of money and I want you to start putting it into an investment account of some sort. I highly recommend using a platform like Questrade with a system like Passive. And what you want to start doing is you want to start having money coming out of your bank account and going into your investment account as if you are making a total mortgage payment equivalent to what it would be if your mortgage renewed today. So in other words, start pretending that your mortgage rate is 4.5% or 5% instead of the 1.2 or the 1.3% that it is. And what this is going to allow you to do is it's going to allow you to do two things. It's going to prepare you for when your payments do go up, so you'll be used to not having that amount of money available to you. And it's also going to create a backstop for you by having money that's put away on a monthly basis and that is invested so that when your mortgage does come up for renewal, you'll have a pretty significant amount of cash, and you can use that cash either to pay down some of your mortgage or as a rainy day fund that you know is on hand and available to you in the event that you need it. And I'd probably recommend the latter, let the money grow, but if you want to pay down your mortgage at that point in time, do it. But the key thing here is if you're on a variable rate mortgage with a fixed payment or you are in a fixed rate mortgage, you need to start acting like you have higher payments right now. You need to start artificially implementing the pain for yourself so that your habits change over time rather than being forced to have them change overnight when your mortgage comes up for renewal. And I know the majority of you are going to watch this. You're going to go, that's a good idea. You're probably not going to do anything. And if you go down that road, you're making a mistake. But if you do decide to go down the road that I've suggested and follow that advice, there's going to be a link in the description below to Passive. There's going to be a link in the description below to Questrade. And I'm going to link to a video at the end of this one that talks about exactly how I built my portfolio. And what I want you to do is set up an automatic payment to Questrade equivalent to the difference in your future payment and your existing payment. Have that money automatically go to Questrade, then use Passive to automatically invest it every single month. And if you do this, you're going to be prepared and you're going to be financially a lot better off. And if you don't, well, the Bank of Canada is forecasting that homeowners are going to feel a lot of pain. And if you don't, you are almost certainly going to be one of those that feels that pain. So check out this video right here for how to set up that portfolio. And then again, Questrade, Passive, those are the tools you want to use in order to set this up so you don't even have to think about it.